Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Landis Williams with us from Orange County, Anaheim area, and Landis is in the lending world. So Landis, it's great to have you on. I'd just love to know a little bit more about how you at such a appear to be such a young age got into being president of your own lending mortgage company.
Thanks for having me on, Bruce. So yeah, I actually get that quite a bit. It's about 7 years ago. I was going through Cal State Fullerton, getting an economics degree, kind of sat back towards the end of it thinking, what am I going to do with this degree? And at that point in time, my business partner currently, Garrett, was like, I think you'll be good in mortgages and real estate. So from there, he brought me on board at the company that he was working with at the time. We worked there for a couple months, got to learn a lot about being a direct lender. And we had a falling out with the company at that point in time. We branched off. We then worked as a broker underneath a DRE brokerage, which is a Department of Real Estate licensed NMLS broker, which means that they're a real estate brokerage that is also endorsed to do mortgage loans. So we got to see that side of things. And we worked there for a couple more months. And at that point in time, that broker had to take a step back because he had his second child and he kind of gave us the reins. So at a very early age, we got to learn a lot and to be put in a position where we were in charge of a lot of things. And from there, we decided that, hey, if we're driving the car, we might as well drive our own car. And then we branched off and we started Your Favorite Lenders. Haven't looked back since.
Nice. So tell me a little bit about that for those of us that don't really know. What does it take from the DRE, from the Department of Real Estate, to become a mortgage broker versus just a straight real estate agent or broker?
Yeah. So what you need to do is you need to first get your real estate broker license. Typically, the requirement for that is you need to have a 4-year degree in some type of business field, or you need to work as a real estate agent for 2 years and then get an endorsement from your real estate broker to then go ahead and be qualified to take the test. From there, once you pass your Department of Real Estate broker exam, you will reach out to the National Mortgage Licensing system and you will get an endorsement. And with that endorsement, they allow you to essentially start writing mortgage loans. And in that process of reaching out to the NMLS, you also need to take your mortgage loan originator exam. That usually takes about 20 hours, at least for California. You'll do a SAFE exam, which is the national test, and then you'll do 1 hour to 8 hours of state-specific licensing. And then once you get that, you're ready to rock and roll as a DRE endorsed mortgage lender. And the main perk of that, a lot of people ask me, why do you go that route? There was a recent ruling in California back in, I believe, like 2016, and they switched it so that loan originators cannot be paid via 1099.
Oh,
So with that, if you have the normal CFL license, which is the California Finance Lender License, you have to pay all your loan officers a W-2, which everyone in the industry knows. They do not want a W-2. They want to be able to deduct expenses, things like that, because there are inherent costs to do business in real estate. So with the DRE mortgage brokerage, you can actually pay your loan officers 1099 because they are technically real estate agents that are able to write mortgage loans. So you're paying them as a real estate agent, even though part of the commission is stemming from mortgage origination.
well, that's interesting. So what's your strategy in terms of marketing? Do you have people that do cold calling? How are you getting loans coming in your door?
Yeah. So we have in-house loan officers who they generate most of their business through cold calling. We use a lot of online advertising, Google, a couple of different websites. Also, our website is very well optimized in search engine optimization to drive clients to look there. We've also won a lot of accolades in the area. Like if you look up your favorite lenders, you'll see that we won top mortgage lender in Orange County for the last 2 years. So when you're searching for a mortgage in Orange County, we're popping up. And then you're clicking on our website, which is then driving you to our company. The other way that we go about it is we build relationships with other real estate brokerages that don't do mortgage loans. And from there, we get a lot of purchase business. And then the third and final way that we get a lot of our business lending, commercial lending, things of that nature is we're very active in chambers of commerce. So every one of our loan officers, we require them to be a member of their local chamber of commerce. And from there, they generate a lot of business. Primarily, there's business owners there, and they're looking for financing for their business, maybe to purchase building, working capital, things of that nature. So that's our third way of generating business.
So are you primarily doing loans in the Orange County area? How broad is your market?
Um, our purchase business is primarily in the Orange County, Los Angeles County, and Riverside County area. Our refinance business, our commercial lending business, and our business financing side of things is nationwide. There are some pockets that we tend to have like a niche in. So in commercial lending, we do a lot of business in the Washington, D.C. area. There's a lot of, there's a ton of multifamily there, big multifamily, so, ranging from 50 units up to like 200 units. And those were built back in the late 60s and 70s. And a lot of those owners, they bought them then, they've held on to them. They really have done very minimal upgrades to the properties. So now that they're coming of age, they're looking to retire, they're looking to step back. The new money is coming in, buying these older properties, renovating them, and turning them into a luxury apartment. So that's where we really strive, is we provide that bridge financing or that fix and flip financing to allow them to acquire these older apartment complexes, renovate all the units, and then get them to current market standards so they can get current market rent.
Wow. So are you cold calling the DC area?
So we actually don't cold call for the commercial loans. We run a lot of online ads. So people are inquiring via that. And then the interesting thing about the commercial industry is it's a lot about who you know and who you do business with. I'm sure, as you know, if you know a good lender, you know somebody who, got a good reputation in the industry, you're the first one to recommend that person to somebody else. So
Right.
we closed a couple loans via our online ads, and then one investor knows another investor who then knows the final end investor who reaches out to us, looking to do the same type of deals that they're doing. That's really how we got a foothold there.
Wow. That's pretty amazing. So just for a little further detail, can you kind of go through the different areas? We did it rather quickly, but can you kind of give us the different area of loans then, and maybe a little bit of feel for kind of what the rates end up being, although they change, I'm sure, moment to moment, but maybe that would be something to kind of converse a little bit further about.
Yeah. So we'll break it down into our general consumer purpose loans, which would be your conventional FHA and VA loans that most people are going to be dealing with in their lifetime. Those rates are going to vary. They're usually, right now, they're in about the 6% range. We've seen, believe it or not, an increase in interest rates, even though the Federal Reserve has dropped the federal funds rate. And the reason for that is the bond traders are pricing in some inflation. They think that inflation is here to stay. They're looking to, increase in the years to come. And they always say that bond traders are the smartest guys in the room because their assets that they're investing in are such long time horizons. Whereas a stock trader, you can buy, sell within a couple days. With bonds, you have to be very cautious because your liquidity pool is a lot smaller. And, if inflation ticks up and you are locked into a really low yielding bond, you can really lose your client a lot of money. And then we do a lot of the purchase business for those type of loans. Primarily, conventional loans are what we're writing a lot of in the Orange County area. With it being a higher price point, we're looking. Generally, our clients are putting anywhere between 5 and 20% down. The biggest thing over here is the price points are very high in Orange County, so that's where we tend to see a lot of people putting the minimum down payment of 5% down, um, because the time it's going to take for them to save up that extra 10-15% is going to take years and years and years. Where if they take a mortgage with 5% down, maybe they're paying $150 a month in mortgage insurance. They can bet on appreciation, and then eventually, in a couple of years, they'll be able to refinance and get out of that mortgage insurance.
Wow.
And the other program that we do a lot of is our fix and flip and our DSCR product. So
What's that? Well, fix and flip, I know, but yeah.
DSCR stands for debt service coverage ratio. This was primarily just a commercial loan product up until about 5 or 6 years ago. And then they started bringing it into the residential mortgage space. For those who aren't familiar with it, essentially, the lender is looking at the property's ability to cover its own debt load. So if they're writing you a mortgage and the mortgage payment on it is $1,000 a month, they want to make sure that the property can at least generate $1,000 a month in rent, to have a 1-to-1 ratio. Higher the coverage ratio, meaning if you get $1,200 a month in rent to cover your $1,000 mortgage, you'd be at a 1.2% ratio. And with that, you get better interest rates, you get better leverage terms. So your down payment can be significantly less on something like that. Generally, the standard down payment is about 20%, but as you start to cash flow more, the bank feels a lot more confident, and they'll let you go down to as little as 10% in some instances if you have a lot of experience and the property generates a lot of cash flow. Another big product is that fix and flip. We do a lot of this in Hawaii, actually. There's a lot.
Really? Wow.
There's a lot. It was very interesting how we came across it. We have 2 team members that joined our team about a year ago, and that was their primary business, was doing fix and flip loans for investors in Hawaii. There's a lot of homes there that were built post World War II, when all the GIs got done with the war and they decided to stay in paradise. And the climate there is not really forgiving for homes. It's great to live in, but the constant rain, the heat, the humidity,
the sea air,
the sea air really degrades these properties. And unfortunately, there's not a lot of money for the locals in that area. It's primarily a tourism based economy. So those that are there tend to not be able to upkeep the homes as much as they should be. So that's where there's a lot of opportunity for fix and flipping there. And we actually work with a couple who has a show on HGTV, Flipping Aloha, and we provide them with all their financing. They do a ton of deals, and when you get to their level, we actually have an in-house product that allows you to wrap in all the payments associated with that fix and flip loan, so that during construction, all you're worrying about is getting the project done, instead of, well, how am I going to make the payment this month, or how much money do we have to set aside for that? So we build that into the loan.
So are you advertising on that program?
We are not advertising on that program. They give us a lot of referrals in that area. But they solely are the face behind all that. We're just behind the scenes providing the financing so that they can acquire the properties, do the work, and have their TV show.
Wow, that's pretty fantastic. So I've heard the flip and fix market and on the mainland has slowed down a little bit. Are you doing some fix and flips here also?
Yeah, we do a lot of fix and flips on the mainland as well. The slowdown has been because consumer interest rates are so high, where previously when they were lower and everyone was trying to buy a house, anyone could make money fix and flipping. You just had to buy the house, put some work into it, and then provide a decent product to the clients. Now, that rates are higher and the payments are significantly higher, there has to be a real like connection between the client looking to buy it at the end of the day and the house itself. They're not just going to buy anything because now it's a substantial amount of money. The average mortgage payment that I'm seeing in Orange County is anywhere between $5,500 and $7,500 a month, which is
Uh,
it's not a small amount of money
no.
when considering home ownership.
Yeah. So if you're buying it and fixing it and spending, 5 to 6,000 a month on interest, that can eat into your profits pretty quickly.
Definitely.
So a lot of lenders don't do both sides. They don't do the consumer side and the non-consumer side, but you have managed to navigate that quite nicely, it sounds like.
Yeah. The way that we've been able to navigate that is we have loan officers that specialize in each of the separate products. I always like to say master of one or master of none at the end of the day. So we have loan officers dedicated to each specific loan product. So when you reach out to them, you're getting an expert in that type of loan, which increases consumer satisfaction, increases the close rate, and generally just makes it a smoother process for everyone involved.
Yeah. And you've got what you said, you have like 19 people working for you now?
Yep, there's about 18 of us in office, and there's about 25 of us in total between operations and things of that nature. Net branches down in San Diego. Um, so in total, about 25 of us.
So what's your kind of diagnosis or crystal ball saying for the future? Are you thinking you're going to be growing? What do you think's going to happen in the next year or two?
So we're in a growth mindset. We always like to say here that, we are our own economy. The only thing that's going to slow us down is ourselves. So hopefully in the next year or so, we're up to about 50 loan officers, and we're hoping to fund about 500 million a year at that point in time. So we've got some lofty goals that we're trying to reach out to, but you don't set lofty goals, you'll never reach greatness.
Yeah, no, that's fantastic. So you're hoping to double in the next year.
Yes, sir.
Wow. All right. So how difficult is it to hire new people?
I wouldn't say that it's difficult to hire new people. It's difficult to hire the right people. So
Uh,
right now, there's a lot of people interested in getting into real estate or mortgages, but it is definitely an industry. It's not an industry for the faint of heart, where you get in what you put in, and generally you won't get what you put in until 60 to 90 days from that initial input of effort. So generally when someone's starting, they're seeing, beach goes like Selling Sunset. They see all these crazy things on Netflix and they're like, well, I'm going to get a Ferrari. I'm going to get this. Um, but as we both know, that is not how real estate works. Later on in life, that definitely is how it works as you build your clientele basis and you truly become an industry expert. But to start, a lot of reaching out to individuals, a lot of no's, where we try to train people that it's never a no, it's a not right now. You may be calling that person, they're at a grocery store, or they just lost out on a bid for a property, and they're just not in the right mindset to talk about financing. So we really try to ingrain in people that it's not a no forever, it's just a not right now. And that's helped us with our retention. We also do a lot of team events, team bonding. Um, Culture is very important for us here. So if you don't fit in the culture, then we don't have a space for you here, unfortunately. Everyone needs to like where they work and like working together. Because at the end of the day, we are a team, and to deliver the best, products, services, and experience to the client, everybody needs to like who they're working with at the end of the day. So that's been our big philosophy behind it all, and that's allowed us to grow to this point. And we get people inquiring to work here all the time. It just isn't a good fit for both parties.
But are you totally 100% commission based? How do you work with people?
So we do have some loan officers who are commission only, and then we also have some loan officers that are on a base plus commission. So it really depends on the stage of the loan officer's career. So in the beginning, they generally like to start with the base plus commission. as they build a book of business, they usually like to transition to that commission only type structure.
So how many, just out of curiosity, how many cold calls are you recommending people make a day?
So currently the minimum is 100 that we recommend. But if you're here for 8 hours, I'd like to see, if you're really trying to put in some effort, about 200 outbounds a day. We like to see like a 10% conversion rate. So you call 200 people, you'll talk to about 20 people. And then of those 20 people, you'll probably get about 2 to 4 applications. So people who actually want to move forward with a loan of that nature. So that's how we base our metrics. Is usually about 10% scaling down from initial contact, pickup, to application to funding.
Yeah. So 200 calls, and maybe out of that, you get 1 or 2 people applying and 1 or 2 people actually converting to a loan. So, if in a month's time period, hopefully you get anywhere from 20 to 30 transactions a month, right?
That's the ultimate goal. During this time, I will say that it is more difficult to get that when rates were really low. That was the conversion that we were looking at. But generally, each loan officer will fund anywhere between 3 and 6 loans per month in the current market. So that's kind of our outlook for them.
And you mentioned that you're using several databases to get your calling information, and I assume that information is pretty easy to acquire, so that you don't spend a lot of time and effort kind of developing database.
Yeah. So we do utilize some third parties to generate leads. And then we also have our own SEO, Google pay-per-clicks, things of that nature that drive leads to us. And with that, it's really just like an intake form: name, phone number, email, type of loan that you're interested in. And that's really all we ask from the consumer. And then from there, it's up to the loan officer to really get the meat and potatoes of what they're looking to do and structure a loan that fits them best.
Well, that's fantastic. It's been great talking to you. Where would people get a hold of you, Landis?
So the easiest way to get a hold of us is through our website, yourfavoritelenders.com. And on there's an inquiry form. There's also our number, which is 714-340-0200. That's going to ring to our main line, where you'll be contacted by a representative of ours. They'll get an understanding of what type of loan you're looking for, and then connect you to the right loan officer.
Fantastic. Well, this was great talking to you. And hold on for just a second here, and we'll finish up. Great to talk.
Great talking to you as well, Bruce. Thank you.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.